The headline says one thing, but the balance sheet tells a completely different story. On paper, the operational performance looks outstanding, with 99.8% occupancy and a dividend yield that comfortably clears our equity risk hurdle. But beneath the corporate optimization narrative, this trust fails our forensic screen on two separate independent safety gates. White Sands sold above valuation, and the headline says the balance sheet just got safer. It did not enough. If you have years of runway left or capital you are not depending on for income, that gap between headline and reality might be worth riding out. If you are drawing down retirement savings, it is not. Institutional analysts at UOB Kay Hian have reiterated their buy rating on Frasers Centrepoint Trust, setting a dividend discount model derived price target of 2.70 Singapore dollars. The entire institutional thesis is celebrating a $467 million divestment of White Sands, which was executed at an 8.4% premium to its independent valuation. For an institutional trader focused on short-term portfolio recycling, this looks like an operational milestone. But for a heartland retail investor building a reliable retirement income stream, the real story is never the exit premium on a single asset. The real story is the structural debt load left behind on the balance sheet. When you scale back the corporate narrative, you find a capital structure that requires major deleveraging to meet basic safety standards. A premium divestment is a fine operational milestone, but it does not automatically turn a highly leveraged balance sheet into a retirement sanctuary. We have to separate tactical real estate transactions from long-term capital preservation. If the core debt metrics remain elevated after selling a prize asset, the fundamental risk profile of your retirement capital has not changed. Let us look at the load-bearing mechanics of the broker's bull case. This valuation of 2.70 Singapore dollars is built on a 6.5% cost of equity assumption and a 2.2% terminal growth rate. The institutional view looks at this portfolio optimization as a clean way to sharpen management focus on the largest, dominant suburban retail assets across Singapore. They see a strengthened balance sheet simply because cash is moving through the door. The transaction itself involves divesting White Sands, the smallest suburban mall in the portfolio located over in Pasir Ris, for 467 million Singapore dollars. The independent valuation stood at 431 million, meaning the trust netted a gain of 32.4 million Singapore dollars at an exit yield of 4.8%. The broker community looks at this $32 million gain and calls it an immediate victory for unit holders. But what is the actual cost of this transaction? White Sands contributed 11.1 million Singapore dollars in net property income during the first half of financial year 26. That is roughly 6.9% of the group's entire rental income wiped out in a single stroke. To account for this lost income, the Analyst house had to trim its financial year 27 distribution per unit forecast. You are trading away real cash-generating income today in exchange for a theoretical reduction in debt tomorrow. The entire broker bull case rests on a single assumption. Divesting White Sands is enough, in their view, to de-risk the capital structure, letting retail consumption growth and asset enhancements drive long-term value without any further balance sheet strain. They are banking heavily on rising shopper traffic, healthy tenant sales, and asset enhancement initiatives at Hougang Mall, Next and Causeway Point to close the income gap. They assume shopping crowds can outrun structural leverage. Our forensic framework does not evaluate retail momentum, shopper footfall, or asset aesthetics. We screen the hard numbers on the balance sheet to see if the capital structure protects a retiree's principal. Applying our 5-layer audit to the verified data reveals two independent structural fractures. No matter how full the malls are, operational strength cannot compensate for a capital structure running past its safety limits. First, let us examine raw leverage. The reported aggregate leverage stands at 40.0% as of 31st March 26. Management guides that pro forma leverage will compress to 36.5% once the White Sands transaction completes around 30th September 26. That is still too high. It fails our 35% hard gate ceiling even after the improvement, and the cushion is thin. A modest 10% downward revaluation of the remaining portfolio would push leverage right back toward 40%, erasing the entire benefit of the sale. Second, the debt service capacity is genuinely strained. The trust's own reported adjusted interest coverage ratio sits at 3.59 times as of 31st March 26. This is a direct failure of our 4-times safety floor. Interest coverage measures how many times over a company's earnings can cover its interest payments. At 3.59 times, the safety buffer is thin, leaving your retirement income highly sensitive to interest rate fluctuations. Third, our corporate leverage metric, net debt to EBITDA. sits at approximately 7.6 times on current verified figures. That is net debt of 2,512 million against trailing EBITDA of 329 million Singapore dollars. Factoring in the post-divestment reductions, the pro forma ratio moves to approximately 6.7 times. Both readings sit inside our 5 to 10 times yellow flag band elevated, worth monitoring but not yet red flag territory. Operationally, the property assets are performing exceptionally well. Portfolio committed occupancy is a stellar 99.8%, with trailing revenue at 499 million and net income at 227 million Singapore dollars. But exceptional occupancy cannot bail out a stretched balance sheet. The entire investment verdict comes down to reconciling a good operational yield with a capital structure that fails two independent hard gates simultaneously. Looking at the consolidated checklist, the dividend yield of 5.38% clears our minimum hurdle and occupancy passes easily. But gearing fails at 36.5% pro forma, and interest coverage fails at 3.59 times. Because of these hard gate violations, this counter faces structural restrictions under our framework and cannot be considered a pristine sanctuary for defensive capital. Our forensic zone system runs from Zone 1 Fortress, the strongest balance sheets with yields above 5.5% and zero weaknesses, down to Zone 5, the red zone. Under our strict compliance standards, a single hard gate failure on gearing, interest coverage, or yield automatically drops a stock to Zone 4 minimum, regardless of how well the operational business is performing. This is a conservative house standard calibrated to protect retirement savings. A secure retirement portfolio requires a stable, predictable distribution path. When we look at recent history, the distribution performance has been remarkably steady on a per-unit basis, but it reveals the hidden cost of constant capital management. Distribution per unit has remained tightly bound around 12 cents annually over recent fiscal years. On a half-yearly basis, first half financial year 26 distribution per unit rose 1.4% to 6.136 cents. Total distributions climbed 13.6% to 125.041 million Singapore dollars. The current yield of 5.38% at a share price of $2.24 looks attractive. But remember, that yield is being produced by a balance sheet running right up against its structural limits. The divergence between the institutional broker perspective and our forensic framework comes down to a fundamental conflict in investment objectives. The broker looks at a property transaction and sees an operational win, projecting capital appreciation toward a 2.70 target price. But our forensic screen is built entirely for retirement capital, where capital preservation is non-negotiable. The institutional framework accepts a 36.5% pro forma leverage and a sub-4 interest coverage ratio because it assumes the trust can easily refinance in a low interest rate environment. Our framework refuses to take that leap of faith. The forensic gap exists because an institutional analyst is paid to find total return momentum, while a retirement investor needs a balance sheet that can survive a severe market shock without cutting distributions. Sacrificing 6.9% of the group's net property income to lower leverage by 3.5 percentage points is an expensive way to deleverage, and it still does not clear our 35% safety ceiling. The remaining portfolio must now work harder to cover the outstanding debt service. Relying on shopping traffic to solve a leverage problem is a speculative corporate trade, not a forensic retirement strategy. The crash was never a surprise. In this market, the difference between a sanctuary and a yield trap is decided before the opening bell, not after the damage is done. The red flags are always there on the balance sheet if you know where to look. The only question is whether you had the forensic framework to read them in time before your capital was committed. Iggy's elite investors didn't chase the headline yield blindly. They had the full forensic breakdown, the gearing ratios, the occupancy gaps, the debt overhang, zero-day reports, and the complete red zone watch list before the market opened and before the price moved. For $9 a month, less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and start being the analyst. To monitor whether Frasers Centrepoint Trust can repair its balance sheet and earn a future upgrade, we track 3 distinct forensic triggers. We do not just sit back. We actively monitor the execution metrics over the next 2 quarters to see if management can push past these structural boundaries. First, we must monitor the formal completion of the White Sands divestment, scheduled for approximately 30th September 26. The critical data point to verify in the subsequent financial disclosure is whether aggregate leverage hits the guided 36.5% pro forma mark, or prints higher due to hidden transaction costs. Second, we must monitor the next full-year results announcement to check if the reported interest coverage ratio can expand past 3.59 times. Any print trending lower toward 3.0 times would indicate rising interest expenses are outstripping rental growth, signaling deeper distribution risk for unit holders. Third, we must track whether net debt to EBITDA, currently in the 6.7 to 7.6 times range, moves meaningfully lower once the divestment proceeds are fully applied, or whether it drifts back upward on renewed borrowing for future retail acquisitions. For a retail investor holding capital inside CPF or SRS, the balance sheet safety margin is your only real protection against the dividend cut. FCT's operational excellence is undisputed. Its malls are nearly full, and a 5.38% yield looks attractive. But when a REIT is failing both its gearing ceiling and its interest coverage floor at the same time, the capital structure has less room to absorb a shock than the yield alone suggests. Income investing means prioritizing financial strength over operational narratives every single time. Frasers Centrepoint Trust concludes this fresh forensic screen with an official assignment of Iggy's Forensic Zone, Zone 4 Caution. This is a REIT where the operational business has outgrown the balance sheet supporting it, and where a retiree's principal has less margin for error than the yield alone would suggest. Until management brings gearing sustainably below 35%, this counter carries too much structural leverage to anchor fresh retirement capital. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MIS licensed financial advisor before committing funds.